Welcome back to another Explainer. Honestly, I am so incredibly excited to have you here today. If you've ever stared at your savings and thought, how do I actually get this money to grow? Well, you're in exactly the right place. Today, we've got a single crystal clear goal. We are going to completely demystify how stocks and ETFs work. By the time we're done here, you're going to have a rock-solid grasp on both of these financial heavyweights.
So, let's just dive right into the core conflict. Should you invest in ETFs or individual stocks? I mean, it's the classic investor's dilemma. Both of these options can absolutely build you serious wealth over time, but they function in totally different ways. We're talking different rules, different risk levels, and vastly different rewards.
To keep things moving efficiently, here is our exact roadmap for today. First, what are stocks and ETFs? Second, the 5 key differences compared. Third, a real-world $1,000 example. Fourth, which strategy actually fits you? And finally, avoiding common investing mistakes.
All right, Section 1. What are stocks and ETFs? Let's define the core concepts. Starting with the basics, a stock represents ownership in a single company. When you buy a stock, say Apple, Microsoft, or Tesla, you're purchasing a literal piece of that specific business. You become a shareholder. If that one company crushes it and becomes more valuable, your investment goes up. Some might even pay you dividends right out of their profits. But here's the catch. Owning a stock means your investment is heavily tied to the success of that one single company. If they do great, you win big. But if they tank, you could definitely lose your money. Now, contrast that with an ETF, which stands for Exchange Traded Fund. The best way to think about an ETF is like a giant basket. Instead of putting your money into just one company, an ETF bundles a ton of different investments together into a single fund. So when you buy just one share of, say, an S&P 500 ETF, you aren't just buying one company. You're effectively buying a tiny piece of hundreds of large American companies across a bunch of different industries, all at the exact same time. Moving right along to Section 2, 5 key differences compared. The tail of the tape.
The first major difference is diversification. It's the single company versus the basket of companies. Look, when you buy one stock, your entire investment rides on that one business. If they hit a rough patch, your portfolio takes a direct hit. But an ETF, it spreads your money out. Even if one company in that basket is having a terrible year, others might be knocking it out of the park, which really helps balance out your overall performance. That built-in diversification is exactly why ETFs are generally seen as a much safer bet.
And that leads us perfectly into difference number 2, risk. Individual stocks carry a much higher specific risk. Think about it. A single company could face a massive lawsuit, sudden new competition, or maybe their CEO gets caught in a huge scandal. Any of those things can cause that specific stock's price to just drop off a cliff overnight. ETFs, on the other hand, offer lower broad risk because you're holding so many different things. A scandal at one company, it has a very limited impact on the entire fund. Just keep in mind, though, ETFs aren't magic. They aren't totally risk-free. If the whole economy or the broader market takes a dive, ETFs can absolutely still lose value. Now, here's where things get really interesting. Difference number 3 is the trade-off in potential returns. Stocks offer massive, explosive growth potential. If you manage to pick a truly great company right before it takes off, your profits can be literally staggering. I mean, people have built immense wealth this way. But ETFs, they generally give you more stable, long-term growth. Because they track so many companies at once, an ETF is rarely going to give you those overnight explosive gains of a single winning stock. But the upside is huge. They help you avoid those devastating, portfolio-crushing losses that come from picking the wrong company. Difference number 4 is all about time and research-intensive analysis versus simple investing. Finding winning individual stocks takes serious work. You've got to understand their business model, read dense financial statements, analyze their competitors, evaluate the leadership team. It is literally a massive part-time job. An ETF, however, is all about simple investing. You can just buy a broad market ETF and just hold it for years without having to constantly obsess over individual company earnings. Finally, difference number 5, costs. With stocks, once you buy the shares, they're yours. There are generally no ongoing management fees. ETFs, however, do charge a tiny fee called an expense ratio to cover the costs of running the fund. But don't let that scare you. Many modern ETFs have extremely low fees, often way less than 1% a year. And for most investors, paying that tiny fraction of a percent is absolutely worth it for the massive diversification you get in return. So when you drop all this into a quick summary matrix to weigh the pros and cons, the trade-off becomes crystal clear, right? Individual stocks demand a ton of research and carry way higher risk for the chance at massive returns. Meanwhile, ETFs give you that high diversification, lower risk, and much less maintenance for stable long-term growth.
All right, Section 3, the $1,000 example. Let's visualize this trade-off in the real world.
Imagine you've got exactly $1,000 sitting in your account right now, ready to invest. What actually happens next? Well, option 1 is dumping a $1,000 into a single stock. If that company crushes it and the stock goes up 30%, boom, your investment jumps to $1,300. But if they miss their earnings and the stock drops 30%, you crash down to just $700. It's a wild ride, and that visually shows you the intense volatility of single stocks. Option 2 is putting that same $1,000 into a diversified ETF. Sure, your gains might be a bit smaller than a top-performing stock's massive jump, but your risk of suddenly plummeting down to $700 is drastically lower, simply because your money is spread out across the whole market.
Section 4. Which strategy fits you? Aligning your goals with your investments. Considering those wild swings we just looked at, picking individual stocks might be your jam if you genuinely enjoy geeking out over research and digging into business fundamentals. You've got to have the stomach for higher risk and the discipline to handle those price swings while aiming for higher returns with a long-term mindset. It can be incredibly rewarding, but it takes real patience.
On the flip side, an ETF investor wants that instant diversification and definitely prefers to sleep soundly with a lower risk profile. This is perfect if you're short on research time, totally new to investing, or just want a really simple long-term strategy. In fact, financial experts constantly recommend ETFs as the absolute best starting point for beginners exactly for this reason.
And hey, remember, you don't actually have to choose just one. You can totally do a hybrid approach. Lots of successful investors build a rock-solid foundation by putting the vast majority of their money, say 80%, into diversified broad ETFs. Then, they carve out a smaller 20% chunk to take chances on individual stocks they've researched and really believe have strong growth potential. It gives you the safety net of diversification plus a little room to chase those higher returns.
Final section, Section 5, Avoiding Common Investing Mistakes, the Rules of the Road. Before you pull the trigger on either strategy, you've got to avoid these common traps. First off, ignore social media hype. It is almost always a trap. Second, please don't put all your money into a single stock. That's just gambling, not investing. Third, avoid emotional decisions. Don't panic sell when the market inevitably drops. And finally, think long-term. Only invest money you won't need to touch for years. We've laid out the mechanics objectively for you today. So ask yourself, based on your own risk tolerance, your goals, and your experience, which strategy are you going to choose? Are you looking for the simplicity and steady safety of an ETF? Or are you ready to roll up your sleeves and hunt for that next superstar stock? The mechanics are in your hands now. Keep exploring, keep learning, and I'll see you in the next explainer.